What is the Fed funds rate? Does that impact mortgage interest rates? Is it the same thing? When that goes up, do the interest rates go up? We get all these kinds of questions and concerns from clients. So this is going to be a short video generally about what the Fed funds rate is and prime rate and mortgage interest rates and how to look at those when you're seeing the news out there. There are some more detailed videos I have specifically when the Fed does different things you can also find on my website. But generally speaking, the Fed funds rate, otherwise known as the overnight rate, that is the interest rate that banks borrow money from each other at, the overnight rate they charge each other on uncollateralized loans, right? And that affects interest rates on things like car loans, credit cards, things like that, HELOCs, lines of credit. And so when the Fed funds rate increases their rate, it will increase those interest rates. But long-term money, 15-year and 30-year mortgage rates, it's not that simple with that, right? Because 13 out of the last 17 times the Fed has made a move, mortgage interest rates short-term go in the opposite direction. That's because of the dynamics in the financial market and what the news, the expected amount the Fed would either raise or lower the Fed funds rate versus what actually happened, and what the overall meaning of that is interpreted by the market. In other words, recently we've seen a lot of Fed hikes, and a couple of those, the first three actually, we saw rates improve because the Fed was seen as hawkish. The Fed funds rate is the only tool that the Federal Reserve has to fight inflation. Inflation is the arch enemy of bonds, which is what mortgage rates are based on. And so it's a cascade effect, right? So when they're hawkish and they're keeping inflation in check, that actually, maybe if they were more hawkish than the news expected or than the market expected, great. Mortgage interest rates typically rally, bonds rally, and interest rates lower. If they're seen not as hawkish, or if the market sees that their move may actually worsen inflation or hurt the economy, then you can typically see mortgage bonds fall in price and rates increase. And so just know that whether the Fed lowers or hikes interest rates, it doesn't mean that your long-term mortgage interest rates are going to raise at that exact amount. And in many cases, again, it goes in the opposite direction. But you do want to watch that, and we watch that for you, of course. And then the prime rate, important to just mention here, people hear that a lot. That is the rate that commercial lenders typically charge their clients, again, on those lines of credit. So if the Fed funds rate is at 0%, prime is 3% above the Fed rate. So that would be your interest rates on those lines of credit is typically going to be around 3% plus potentially a margin that the bank charges. If the Fed funds rate is at 3%, that rate is at least 6%, right? And so that is the way to look at rates. And hopefully that helps you in the news and not panic or get too excited based on what the Fed does. But we are here for you, of course, if you have any questions on that. Thank you. Have a great day and good luck out there.